All right. Welcome to Wall Street Jack Boys Game Plan Sunday. Today is June 23rd, and we're here with our session live. As we assess the markets, we're going to take a look at what occurred over the past week. We'll take a look at what's in the pipeline for this week and other current events, possible, probable risks in the markets that would impact our ability to make money and a strategy to move forward. So there's been a lot that's going on here. I do want to thank everybody for showing up today. And, on our Facebook side, the Facebook crew, make sure y'all hit that share button, hit the like buttons, and make sure that, other people are getting this wisdom here. So we're just going to take a look at, what occurred over the past week, which the markets, as you guys see, we were hitting record highs over the past week. And a lot of that, exuberance in the markets come from the Fed. So we had Fed's meetings, which we knew about on Wednesday. So Tuesday and Wednesday, it's always a two-day meeting. And the market's anticipation of a rate cut. There were some probabilities that they would possibly have cut the rates this month. But for the majority, probabilities are actually next month. So the July Fed meeting, we pretty much are at a 100% probability of a rate cut. And though the Feds didn't cut the rates, they had a accommodative tone in their speech. I posted all the stuff in the group, so if you guys in the group, you'll see it. You can read it yourself. And basically, the Fed's just saying that they're going to do whatever they can to keep the expansion going, So everything they can do to keep the expansion going. And we say keep the expansion going, meaning this 10-year bull market, which is, it's a long bull market, breaking a record, right, for the longest bull market ever. And the Fed's goal is to, as they mentioned, that they're going to do everything they can to keep the markets rolling. And what that says to investors in the markets is that they're going to cut rates, right? Because again, when they cut rates, the cost of doing business is cheap, and cost of money is cheap. So when you give people more money, you give investors more money, you give the markets more money, what do? Spend more money. And our economy is driven off of people spending money. So there you have it. Pretty much the market hit its new highs on Thursday after the Fed's meeting, basically. So we did hit record highs, and I'll pull up the charts here for you guys in a few moments, but we did hit record highs in the S&P 500. But what was interesting is that not only did we hit record highs in equities, we also hit record highs in gold. We also hit record highs in bonds. Okay, so this is red flags all over the place. Okay, so in the group I posted for you guys, don't get too arrogant. Okay, that means that if you're going to play in this environment, you need to trade, put your stop losses in there and everything, just because it's a treacherous environment. Okay, when I say treacherous environment, I mean that you need to play it conservative. You have to play it conservative because you have a lot of divergences that's in there. Okay, so normally equities, when equities move up, okay, normally gold and bonds is going the opposite direction. Now, when they move simultaneously in the same direction, you have a divergence. That's not the way it's supposed to be. Somebody's going to get their head cracked because it's got to make a move one way or another, right? We don't know which way it's going to move, but one of them got to give. They don't move together that way, right? Bonds and gold represent safety. That's a flight to safety, okay? And what's moving all of this, again, you're talking about smart money, okay? Institutions, big boys, they got the big money. So they're the ones who making the markets move. So you got to follow smart money. What is smart money doing? When you see things like the equities are, pumping up off of something that hasn't even occurred yet, right? The equity's been kind of crazy. For the main part, we have the trade wars with China. That's still going on right now. No resolve. We did get a resolve with the situation with Mexico, but all of this is a news-fueled market, which makes it very treacherous, right? Any given day, Trump can just tweet and you just, wipe out half your account. Just all based on what he tweeted. And we saw some of that this week on Friday, right? With the situation with Iran. He was about to drop some bombs or something. Then at the end of the day, he decided not to. And so, and then the markets are just irrational, at this moment, we're at the end of a bull cycle. And, it is what it is. If you understand the economic cycle, that means we're at the end of this cycle. I showed you guys several times that what we see with these indicators is that there's a recession that is going to come. Okay. Now, there are some that believe that the recession is already happening. Okay. I don't see that just yet. But what happens is when the Feds cut the rates, that is a signal that you're in a recession. So why is it that the Feds are going to cut interest rates in a booming market, right? So you say something isn't right, right? Something's got to be wrong if they're going to cut interest rates, right? And let me just pull up our handy dandy yield curve chart here again. Okay, so if you guys haven't subscribed to the courses, I'm not going to go through the whole econ thing here, but I teach you all this stuff in our classes so you can understand it. So when you hear it on the news, you know what the hell they talking about. Okay, so if you just take a look here, this is on our website, by the way. You can see WallStreetJackBoys.com/treasury yield curve. And our courses and everything is here. So you want the training, you get it there, Wall Street Jack Boys. But anyhow, so taking a look at this handy dandy yield curve, you hear it in the market, just don't know what the hell it is. Basically, this is what's happening. Okay. Presidents and all that stuff don't really have nothing to do with why this market is moving. It comes down to the Feds. So I'm going to give you, let's see if I can take it all the way back here. All right, cool. So as I told you guys before, there is a recession that is coming. How do we know? Well, this handy dandy yield curve here is the most accurate tool, okay, that predicts recessions. All right. And this is basically bonds. So you got to pay attention to the bond markets. The bond market tell us what's happening. Okay. The Feds control the interest rates, the yield, the rewards. And so when we get that inversion in the markets, there's a recession that follows. Okay. So here's a recession here. All right, you guys can see it. Anytime the stuff crosses over, there's a recession there. There's a recession there. So what you're paying attention to is this gray line, which is a three-month notes, bills, 3-month bills, and then the 10-year notes, those bonds there. And short money, you're not supposed to make more money off the short money than the long money. So when it actually crosses over, that's the inversion. That's not the way it's supposed to go. Okay. So anyhow, let me just keep this up here. Long story short, again, if you don't have the class, all of this is a part of our class. We teach more than just trading. This is wisdom. Okay. So every time these two lines, the gray and the blue line, just, you don't have to be a rocket scientist, but just follow me here. Every time they touch, okay, when they come up and they touch and they cross, there's an inversion. And then you see the Feds control the gray line. So then they cut the rates. Okay. So recession, they had to cut the rates. All right. Recession, they had to cut the rates. Recession, they had to cut the rates. Okay. And it don't happen until the lines cross. That's where we have the inversion. What you see right now is an inversion. So when we say that there's a recession that's coming, what's good, Terry? When we say there's a recession that's coming, it's not for shits and giggles. It's just, that's what the technicals are telling us here. So pay attention to these numbers on the side. These are the interest rates. Okay. This interest rates, again, that tell you, should you be putting money in your savings account? Should you put money in bonds? Should you put money in gold? It tells you everything you need to do from this interest rates. Okay. If you don't have the education, you will not understand. That's how a lot of people end up on the wrong side of the markets. You got to understand this stuff. Well, you don't really necessarily have to. You can follow all the smart money. But for me, I don't like being a follower. OK, when I train people, I train you to learn as much as I can. You can be independent on your own. That's the way that everybody should be, I feel. But if you want to be a follower, continue to be a follower. As long as you follow the right information. There's a lot of news that's out there. All these news people are salesmen. They sell all day. Whatever propaganda that their association is paying them to push, that's what they do. But if you understand the science, this stuff is science and math, basically. OK, once you understand how this stuff works, then you'll be in a better situation. But if I show you here the rates, OK, these are the rates here from 0, you see all the way to 8%. The Feds encourage the economy. So the Feds, we're going to write up here, Fed. We ain't talking about the police, the FBI. We're talking about the Federal Reserve. OK, these are the guys who control the money. They control the environment that we're in. OK, so when the Feds raise interest rates, OK, there's something that happens in the markets. OK, it actually cuts credit. It cuts the flow of money. When they lower interest rates, it encourages the markets, encourages the spending. OK, The cost of doing business is much cheaper. So it actually puts more money into the economy. Fake money is credit, right? Credit is debt. Remember that. So when you're actually looking at this, you can see, well, through whatever expansion, when the Feds actually do their thing, when they actually raise the rates, you see this? They raise it. These are all the points where they raise, okay? They raise until it tips and you get that recession. You get that recession. See that raise? You get that recession. The same thing happened back here every time, okay? That actually cuts off credit. That means like your credit scores, whatever your credit score was before that last increase, you no longer qualify if you're at the bottom of that tier. You no longer qualify to get credit. Same thing for businesses, corporations. You can't get money. You can't grow your business, right? So you can't do that. Then you actually get a slowdown in the economy, okay? It makes things slow down because people are not spending money. Remember, we're in an economy that's driven by people spending money. You guys participate in this big matrix, in this big game. Whether you realize it or not, we all participate in it when we're spending our money, okay? And so anyhow, as the Feds, if you may hear, just take a look at, I'm going to show you guys something here. Now, this is 2008 and this is 2016. You guys all know the president of the United States was Obama. So you hear Obama years and say the economy was actually doing really great. So this is what happened though, okay? This is what really happened for you guys don't know. The Feds dropped the interest rates to zero because it was a recession, but they actually dropped it down to zero. These are the lowest levels ever. Not only did they just drop it to zero, but they kept it down for its whole tenure. And this is record breaking time. I mean, you know, again, they never kept the rates. When they drop the rates, they never keep it down for 8 years. This is just asinine, okay? If you look back here, it's about 2 years. You look back here, it's about 2 years. What happened here? Did they fall asleep? They made a mistake because everything that they did to try to get the economy pumping back up, they still haven't hit their targets, and it's showing issues with the Fed. I just wouldn't want to be the Fed right now. We want to be Jay Powell. Y'all hear this guy in the news all the time, Fed, Trump talking about firing him and blah, blah, blah. You know that the Fed is independent of the president. So, I mean, it's interesting. It's news. It's, you know, it's propaganda. It's entertaining. But this is what's happening. Okay. Under the Obama years, money was the cheapest that it can get. Okay. That was your time you're supposed to be buying up. So this is how the Feds encourage the economy to grow. You make the cost of doing business. You make the cost of money cheap. All right. And they have zero. Now, when Trump get into office, okay, now we go into the Trump years. You guys hear Trump beefing, and he'd be mad because he says he wants the same deals that Obama had. He want that zero. He's like, I can grow the economy a whole lot better if I had zero interest rates, right? But what had happened instead is the Fed started increasing the rates right at his timing. We started increasing it pretty fast, okay? And so remember, they increased the rates until it breaks, okay? Until the economy has had enough, okay? And then that recession follows. So that's what we're seeing here. If you understand patterns, these things happen over and over again. The economic cycle is a cycle. These things happen over and over again, okay? So we see it happen here in the past. I mean, we have other data charts I can show you guys. You go to the St. Louis Fed website and you'll see, I mean, they go way back to like the 30s, okay? This happens every freaking time, okay? This is where we are right now. So after you see what I show you, it's in the data, right? What do you think is going to happen here? Based off of historical evidence. We ain't talking about what the news guys talking about. We ain't talking about Jim Cramer. We ain't talking about nobody else. We're talking about the data. When you're looking at the data, anybody want to guess what happens here? This is where we are. You ever see those maps that say, you are here. You are here. This is where you currently are. It's important that you understand your environment that you're in. Okay. This is where you are. Anybody want to take a wild guess what's going to happen here? The same thing you see happen over and over again. Okay. Recession. And then the Feds cut the rates. right? Because they had to stop it from breaking. They're trying to stop it from breaking, so they cut it, okay? They try to stop it from breaking, so they cut it. Your price is way too high. You need to cut it. You know that song? What's good, Demeter? What's good, Ashley? How you guys doing? What's good, Terry? See you guys. All right, so here, that's what the meeting was all about, okay, this past week. It said the Feds are saying that basically the market makers are, anticipating the pricing in the markets that the Feds are going to cut the rates. Now, when you see the rates cut like this, okay, that's a recession. Now, the Feds know something is not working. Okay, something is wrong. The only time you see if the economy is good, you're supposed to increase to stop it from cooling off. If you remember last year, if you guys were in the markets last year, you remember the whole deal was they started increasing the rates because they said, hey, the economy is so strong, blah, blah, blah. We need to increase interest rates. And they started increasing. It was all good about a week ago, right? It was all good around this level. But when they got up to these levels, the market is just like, oh, hell no, y'all doing way too much now. Now, we were okay with y'all raising a little bit, right? But you're doing way too much, way too fast. We want to keep the expansion going. Okay, remember I showed you on the Obama years, the expansion. Okay, did the expansion come from the president? No, it came from the Feds. All right, they create the booms and the busts. They create the inflations. They create the bubbles. We wrote an article about inequality. All this stuff is really coming from the Feds. They just can't control the outcome of it, but they actually are the ones who create the bubbles. They create them and then they burst them. Okay. And so their target, the reason why they do this is because they want to combat inflation. Right now, they have an issue with inflation. They had this goal of like 2% inflation, and they can't seem to hit this target. Okay. Their goal is to get to 2%. So it just seems as if inflation is dead. Okay. But the way that they gauge this stuff, they're looking at things like the CPE, CPI. They're looking at how you guys are spending money. Okay. It's the indicator. All right. And basically, they don't include food or energy. They don't include food and energy. So I don't know if your food price is going up, if your gas price is going up, your oil price is going up. But in their studies, they don't include these things because they say it's too volatile. Okay. And so I'm just under the impression that basically because they don't include these things, that what they're gauging is just not right. Okay. It's not right. And so anyhow, they're just making moves to keep this thing going, to pump more money into the economy. It's fake. It's not real. Okay. But the stock market wants to keep it going. Anyhow, make sure you guys get the courses so you can get this information, which we go over. It's like a 2-hour course. It's one of our many courses on the website. But basically, it's just, showing you the manipulation that we have in the markets. And the stock market is not the economy, for those who don't know. Okay, the stock market is one of the indicators of the economy. And so it's great when the stock market is doing good, but it is not the whole picture of the economy. Okay, so you got to keep your head out. I've been posting some things online on my page here, social indicators and things like that with layoffs and blah, blah, blah. But you see those things, they start to happen in the market. The wealth gap grows because those people who understand this stuff that I'm showing you guys for free, they got their education in this stuff. They got the knowledge because the knowledge is the power, and they leverage it so that they can actually grow wealth. And that's why you have the wealth inequality. Okay. You got the Feds interfering, but these guys understand how they work and they leverage that information. That's what it is. So anyhow, so the markets are excited about that because it's going to give them more power to pump up the asset prices. Asset prices you put more money in the economy, people spend more money. When people spend more money, the price of things go up. Okay. And so right now, even in the home buyers, which we got a report coming out this week about home sales, mortgage rates are super low. Like you can go I think like 3.8%, super low. It's like a good time to refinance your homes and everything. But people are not, buying new homes. I think they have like 16 consecutive sessions of no growth or decline and buying homes. It's too expensive for people to buy homes. A lot of people are renting now because it makes more sense. Like buying homes, it's all science. You got to know what part of the cycle you're in. It's not always just, oh, just be real estate and that's the thing. It doesn't work that way. You got to understand what side of the market you're on. And for right now, people are just not buying as many homes as they're expecting. And so that's why you had the feds and them doing what they're doing, so they could try to get this stuff down so they can get people spending more money, right? Spending more. But it's already economic slowdown, GDP projections, and everything is down. We got earnings coming up here pretty soon. In fact, I think we have earnings with FedEx this Tuesday. So I'll be paying attention to see what's going on with FedEx, see how they're doing with their shipping and stuff like that. But it's already, a lot of companies is already downgrading their projections in the future because of the slowdown. A lot of this is coming from the trade deals with China, with Trump and China, US and China, however you want to word it. But it is having a negative impact on companies, employers. And then you're starting to see a lot of companies actually shutting down. Over 7,000 stores shutting down. And the year isn't even over yet. So the evidence is there with the slowdown. So it's important that you guys prepare. Calling it, like it is, based off the data I just showed you guys. There's a recession that's coming, and the feds are trying to do everything they can to stop it. Now, this stuff is big, it's global, okay? It's not just the US. We're like the top dog, but this is all over with Europe, China, and everything. So all the, Europe, Mario Draghi, he is like the Fed. He's the Jay Powell of Europe with the ECB, which is the European Central Bank. And, he's actually getting ready to retire, I think in like 4 months. But there's going to be somebody who's going to take his place. And last week, the markets was raising up also, not just because of Jay Powell, but because of Mario Draghi around the world and Europe, talking about the same thing, how they're cutting rates and they're going to put more money in the economy. They're going to buy things up to keep the expansion going. And so that's another thing. So you have Europe doing it. Now you have America that is signaling that we're going to do it starting next month. And, that's what you have. And so anyhow, the markets is moving that in that direction. So these are some key things to keep in mind that's coming up this week. G20 conference, the G20 summit. OK, all the leaders of the world, they're going to be at the G20 spot this Friday. OK, everybody's anticipating some progress with the trade deal with China and President Xi of China. OK, Trump and China based Trump and Xi. So we don't know how this is going to play out until it plays out. But Friday, it's going to be some moves up until Friday. But Friday is going to be a major event. From that, we'll see how the markets behave. The markets is going to behave either good or bad, depending on the outcome. Do they make progress with it, or do things get worse? Another thing to keep your eyes out on is the situation with Iran. U.S. and Iran stuff is actually escalating. It's kind of getting a little out of hand. Trump was just about to drop bombs on him on Friday, changed his mind at the last minute, which is kind of weird. But keep your ears open for those developments, because if that situation deteriorates, things can get really bad. The markets is not going, the markets don't like that kind of stuff. So the markets are starting to sell off. And let me just take a look here. I just showed you guys gold. Gold has been doing really, really good. Gold has been pretty strong. And gold, again, is a flight to safety. Gold is a flight to safety. So smart money goes into gold when things is just not looking good on equities. Stocks are looking bad. Things looking bad. All right. Yeah. Consumer price expenditures. It's just about you guys spending money. Yeah. CPE indicators. That's a economic indicator that you should pay attention to. And they deliver these reports, every so often. So we pay attention to that. But anyhow, so with gold, all right, so cool. You guys see gold is actually back in the game now. Gold has been take a look at this. This is 2008, right? Show you guys, this is the crisis, right? So with the Great Recession, you see gold just did a run up, boom, killed them, right? Gold was doing it big. And then with the as the expansion started to continue, gold's been selling off and people has written gold off. Gold has not been doing too well. It's been chopping sideways. But this 100 moving average, again, this is on a monthly chart. Gold has held this position very strong. Okay. It's came down, it's bounced off of it. It's come down, it's bounced off of it. And it's in a bullish pattern now. So This is a bigger time. This is a monthly time frame because I want to show you guys back here, the trend. And so my belief is that gold is going to continue to go up. Now, these are certain reasons why gold is going to go up. And it's for one, it's because of the level of uncertainty. Smart money don't like taking unnecessary risk. Okay. Smart money is the institutions, the portfolio managers. When these guys are talking, they do not, a lot of them are actually pulling out. They don't even want to deal with this because it's really choppy right now. Okay. We need certainty. And we can deal with risk, but when there's unnecessary risk, then you don't want to be risking capital when things are just, chaotic, basically. All right. So anyhow, so what they do is instead of, pouring all your money into stocks, they go into things like safety, which is gold. Now, gold doesn't have yield. So you also have them to go into bonds as well. Now, the interesting thing is that across the world, other economic indicators, like I showed you guys the bonds there. What's good, Tawana? How you doing? What's good, Michaela? What's good, Vanessa? Yeah, I'll show you guys the bonds. There's negative yields on bonds across the whole world right now. When I tell you it's so ridiculous, it's so much negative yields out there. It don't even make any sense. It's something that is wrong, and they are trying to, put a Band-Aid on it and then shoot it with some steroids and get it back in the game, basically. But it's hurt, it's injured. And so without proper care, it's going to fall over. So you have, anyhow, when you take a look around the world, you have, like in the European countries, they have negative yield on bonds. Now, the whole purpose of bonds, understand the bond market is this. It's the safest. Let me pull up bonds here. I'm going to pull up the 10-year. So this is a safe haven, okay? This is for the government. So y'all know that the government don't make money. I hope y'all know that. If you don't now, government don't make money. They make money by taxing citizens or selling bonds. Okay. And this is the way they do it right here in the stock market, right? So we're looking at the bond market here. And basically, they sell the bonds and people buy the bonds. They're buying it because they get a guaranteed return on their investment, which is the interest rate. So it's the interest. That is their yield. Okay. So your yield is supposed to be positive because if I give you some of my money, I want a positive return. I want, 2%, 3%, 4, 5, 6%, right? But now you have negative interest rates, and you guys will see this all over the headline. So you understand it when you start to see it. You have negative interest rates where you give the government your money and you're not making no money off of it. It's negative. And the consensus about it is that basically, you got to pay attention to the bond markets because the bond markets know. So if people are willing to give the government their money and take interest, and again, this is not U.S. We're positive. OK, this is Europe. OK, it's across the world. Right. Everybody else in the world. U.S. is top dog. We're at the top. Everybody else is struggling. OK. And anyhow, when you have investors that's, willing to give their government money and not make no money off of it, actually be negative on it. It's freaking crazy. OK. Now, why would they be doing that? That don't even make sense. These people are not stupid people. They are, intelligent. These people got degrees and Nobel Prizes, blah, blah, blah. Why are they doing that? Because the situation can be worse than it is today. That's why. So you got to pay attention to that. And so don't fall into the sugar highs that we're getting here. So that's why I tell you guys, don't be arrogant right now. So you may see again, the market's hitting new highs. But the economy and the stock market are two different things. So tread softly. OK, now, these are some other things. I told you guys about the trade wars. I told you guys about the G20, which is coming up on Friday. Now, long term down the stretch, we have 2020 election. This is major. So all of the developments that you're seeing is a play out into the elections. OK, now, one of the key things is the markets. They love Trump. And in order to keep Trump in office, they would need to do everything they can to avoid a recession, right? Because that wouldn't look good. Now, even though that's the case, the recession it's a part of the natural order. It's a part of the economic cycle itself. The bubble, the boom cannot last forever. And so it would be better if they just go ahead and just let it do what it naturally supposed to do instead of them trying to come in, pump it with some more Kool-Aid, give it a sugar high, give it a Red Bull high. And then when it hits, it's going to crash really hard because it has to. It's just the way the economic cycle works with credit and debt. So when you guys have questions about that, just, let me know and we'll try to get you caught up. But again, we teach the course. It's part of our curriculum here at Wall Street Jap Boys. So make sure you go to wallstreetjapboys.com and sign up. But anyhow, it'd be better if they do it now. Just go ahead and get it over with. But they're not. They're going to try to keep it going because you need the economy to continue to look strong. You need a strong stock market. And this is all a positive note for Trump 2020. Okay, so just remember that's coming. Okay, so you got to know, this is chess. You got to think 10 steps ahead. What are the playouts and what you see for the technicals, and then what's the story? Okay, so anyhow, you got that going. And so there's a need to keep the markets pumping. The Fed said they're going to try to keep it pumping up until then, but inevitably it's going to end up, crashing. So it's just, I think the goal is to try to keep it prolonged until he get re-election. So once he get re-election, then he can do what it's going to do, because then you got 4 years of whatever, the markets want and need on that side. So, all right. So basically that's the smart money. Bonds has been real good here. I'm on a daily chart here. As you see, bonds has been actually pretty positive, but they're extended. Okay. And so you got to tread softly here. I do have some trend indicators that's actually starting to indicate to the downside. So we may see some breathing here in bonds, but gold is actually still trending north. So I don't really know what to make out of that situation. Again, this is like uncertainty that we talk about. So let's take a look here at the S&Ps. So this is the S&P 500 right here. This is the ES. Okay. And so let's pull. All right, let me pull that up. Okay, cool. So you guys saw the last highs when the markets hit. Okay, here we go. We go to the last highs here. Okay. These are the last two highs that the markets hit. Okay, and those are pretty cool double top patterns, which you can see as clear as day. Okay. And the market is at that same level again. Now the market has trouble with breaking through this level here, but it did pierce its new high. Okay. It did hit its new high. So that's an objective. That's a bragging right? But we're still here and it hasn't cleared that section yet. And it is, if we look here, it is overbought. It is overbought. Okay. It means it's too expensive. So it's going to have to make some come down. Now the trend is still up. So this indicator is not working in the direction that I'm actually thinking here, but it's up, against that resistance level again. And so it has hit its objective, but we may see it continue to go sideways a little bit and then tank over again. So that's one scenario that we're looking at, or, it could push through, okay, again, and hit those and try to go, racing towards the 3,000 level. Okay. So that's the next target to the upside. That's if things maintain, a positive. So what could contribute to that? Well, situation is positive. They make a deal, Trump and Z this weekend, then that can be a catalyst to actually move this thing where it needs to be. Okay. But y'all know how Trump is, so I wouldn't count on it, but you can see. All right. And what I'm looking at here is I'm looking at a lot of other things that are overbought. For instance, I haven't really seen too much, and I'm not putting on too much risk right now because of the level of uncertainty right now. It's messing with the direction. And again, I got bonds moving up, I got gold moving up, and I got the equities moving all up at the same direction. And so as far as direction, I need to see which one is going to break first. Now I'm guessing that bonds is going to probably break first because I'm starting to see a weakness there already. However, I think I will actually like to get some short exposure here in Walmart. Now, this is the reason why this is not my typical squeeze play, but what I do see is that Walmart is overbought, it's overpriced. Okay. And so 127.2 extension on the Fibonacci. Okay. That's actually the level that we're eyeing here. Walmart has had a nice run up, and our indicator here is showing us that it is overbought and we have a trigger to sell, right? Also, same thing. Okay, so the momentum is still high, but it looked like it's peaking. Okay, if you take a look at all the other time where expansion happened, when the momentum was bullish, it looks pretty similar to where this one should be ending off at the same time. Okay, But even if I look at, underside here, I'm showing here that the momentum is starting to slow down as well. And so I would like to catch it down to the mean. Let me actually go in some. All right. Yeah. And so about the 108 mark, I'd like to catch it to a pullback to about at least 108. I don't know if that's going to, sustain, but this is what I would like to catch it at. So I'd like to short it up here, catch it down to the 108, close out the position. All right. And then redirect that capital to some other things. But that's what I'm looking at right now. What else? Let me take a look at the oil markets as well. Let me just see here real quick. Oil markets is rallying up. Now this is and this is another thing, looking in the markets here, I'm seeing a lot of this is that the trends are not all the way intact. Okay. Meaning that like what we're seeing here with oil is it's a counter trend trade, because if we're looking at our moving averages, the stock itself is trading under all the major moving averages. So that's the key level of resistance here. Okay. And even though you had a nice double bottom pattern here, this is bottom one, bottom two, it's coming up. It's up against this level of resistance here. Don't know what to make out of it, if it's going to break through or if it's going to get rejected and come back down. Either one of these situations could happen. So, Monday would be the watching game to see how the stock behaves at this point. So even though we did get a buy trigger here, we also got to pay attention to key level of resistance up ahead. All right. We don't want to get smacked into a brick wall here. So we want to see how it's going to behave up against these levels. If it pushes further up, then I would like to get in some exposure in oil. But again, that's contingent off of if we see it move forward. Okay. And some of the stocks that we like to play in oil will be XOM or HES. Excuse me. Let me get this out of here. Okay. So yeah. So you'll take a look at like XOM, and you see this pattern. The chart pattern is the same as the oil pattern there. HES. Okay. So those are some other situations, other developments that we're looking at. Looks like OPEC is having issues in the oil rim. And so can they create stability there? Don't really know. We'll see. But I don't really have any positive outlook on many things as of right now. And I'm just playing it safe right now, being a little more conservative. We'll wait. Probably won't throw on any trades on Monday. We'll see, because the markets are crazy. But Tuesdays, you get a better look at how the market is behaving. And then we'll try to get in, either late Monday, Tuesday, get out by Friday, because we don't know what's going to happen. It's G20. So again, that's unnecessary risk. Don't take on that kind of risk, because you don't know how Trump is. Dude is unstable. Anything liable to happen. Okay. So don't let Trump mess up your world. But so get your profit, from, Tuesday to Friday. Try to get out of your position. I wouldn't hold anything past Friday, because we don't know how that's going to turn out. And so, and gold again, is still strong. So we'll see how that plays out. So that's what I have for the week. You guys have anything that y'all want to look at? I'll take a look at a couple of tickets from you guys, and then we'll go ahead and bring the session to a close. Again, make sure you guys check out the website, wallstreetjapboys.com. You can get the classes, you get the training. We also have merch. We got gear. It's not our biggest thing, but if you, want to support, you want to represent, you're taking on a new lifestyle, it's something good to throw on, So those are on the website as well. You guys can get those. Make sure you subscribe to the newsletter, which is free. Newsletters is on the website. It's on Facebook. If you need a link, I'll make sure to drop it to you. Just let me know. And so you guys can stay informed. We try to drop some pretty dope newsletters every month. You know what I'm saying? So again, what we do is we take information, we take knowledge and wisdom, and we break it down to the everyday man, so that you guys can understand this stuff. The information is out there. You can go to CNBC or anybody else, but I'm pretty sure you're not going to get the breakdown the way I give you the breakdown. So that's another great reason for you to join Wall Street Jack Boys. All right. Then nobody had no tickets that you want to look at. I give y'all about another minute. And if y'all don't have any tickets you want to look at, we'll go ahead and bring it to a close. If you're looking at gold, GLD, this is a good ticker here. It has hit this extension at the top. Okay. Has hit this extension at the top. And so we should get a pullback here, but it ain't no telling right now. And bonds, needs to look at TLT. Okay. We have our extension here. It has behaved towards our extension, and we're starting to see it relax a bit here. Let's come back to the mean. It's right there. All right. Bonds. Let me pull over my squeeze indicator to see if we have any squeeze setups here with the Wall Street Jack Boys squeeze scan. When you remember, you get the scan, so you don't have to be running around like chicken with your head cut off trying to find setups. This scan here is pretty cool. If you look down there, we got United Healthcare has a squeeze. Again, this has a squeeze, and it is in a counter trend trade. So first thing we do is we have to assess the trend itself. It's traded under its major 200 moving average. Okay. But it has hit its floor and has been trending upward. So this is a counter trend trade. Now it has broken up above the 100, but it still has that level of resistance up ahead. And they got earnings coming up also. So, play it conservative. You throw in some spreads if you're going to play it to the north side. What's good, Victoria? What's good? I see you guys. All right. So with that being said, I'm going to go ahead and bring the session to a close. Again, I appreciate you guys showing up. Make sure you subscribe to those newsletters. Make sure you join our group on Facebook, Wall Street Jack Boys. It is free. Just sign up, fill out the questionnaire. Spam is at an all-time high. I am combating spam all the time. So if you're referring anybody to join our group so you guys can see how we are actually doing in the markets every day, day in and day out, and get yourself some ideas to make you some money as well. Make sure they fill out the questionnaire because, again, I don't know who spam. I have so many people on my waiting list to be friends with me. I don't know who to add because spam is just crazy. So make sure you guys fill out the questionnaire. We'll actually let you in there. That just lets us know that you're not a robot. Okay. Anyhow, I appreciate it. You guys have a good night. Enjoy your weekend. Peace.